JPMorgan Chase just issued a chilling warning to its clients, and what's coming next could shake the financial world to its core. Stay tuned. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, Jamie Dimon has spoken in his latest warning, saying shockwaves through Wall Street. Here's why it could end in a financial firestorm. Plus, we have a sponsor for today's show. We'd like to welcome La Rosa Holdings back to the show. You can find them on the NASDAQ symbol LRHC, and they're a holding company that operates 6 agent-centric technology integrated real estate segments that aims to disrupt the real estate industry. Recent buying activity over the past 30 days has established strong support for La Rosa's stock, positioning for a potential 85% upside return. Just wait until you see the charts. Now, let's head over to Bloomberg, where we picked today's start with the headline. JPMorgan's Dimon sees inflated stocks as animal spirits return. And after the election, investors piled into stocks, and on the pullback, they went all in, hoping for a repeat of what happened in the equity markets during Trump's first term. But Jamie Dimon is saying, hold off, that's not likely to repeat again. Asset prices are kind of inflated in the U.S. stock market, CEO Jamie Dimon said. You need fairly good outcomes to justify those prices, and we're all hoping for that. I think having pro-growth strategies helps make that happen, but there are negatives out there, and they can tend to surprise you. So what he's saying is investors have front-run the economy. They've gone all in on stocks, making equity prices well overvalued to earnings, and that's a huge risk as we're now full force into earnings season, because there are surprises, he says, could shake the market and rattle it right to its core. JP Morgan's outgoing president Daniel Pinto said that the U.S. economy is in a good place, although inflation and geopolitics could derail optimism. We haven't seen geopolitics have any effect on the equity market rally, but we do know inflation can. Now, investors love inflation because it drives up prices, and that means earnings go up, and of course stock prices must fall. There's a big problem, though, is that inflation can send stock prices crashing. Let's take a look at these next charts, and you can see the risk here that JP Morgan is warning its clients about. As we take a look at the consumer price index shown in blue against the NASDAQ 100, and you can go all the way back to the 1990s here, where you see starting around 1999, inflation is rising and stocks are going right along with it because the economy can handle higher prices. But there's a point where you see inflation start to peak, and what happens? Equity prices peak as well. Stocks start to lead to the downside, and next thing you know, we're following a path of disinflation right into the dot-com bubble. We see a similar setup around 2007, where inflation starts to rally. Stocks are headed higher as investors are saying this is going to lead to a big potential return in equity prices. What happens? Inflation continues to surge, stock prices peak and roll over, and next thing you know, we're in a deflationary spiral called the global financial crisis. Let's fast forward to 2021, where we see inflation surging. That brings asset prices up with it. The problem is asset prices start to peak when inflation gets too hot. They both come down, but then all of a sudden investors go all in on a big bet that equity prices are going to go higher, buying every dip from here up as inflation continues to fall. Now, what this means is that investors are hoping that inflation comes down and spending continues to drive at these higher prices, meaning equity prices must go up. But there's some risks that come with inflation. Let's take a look, because when we start to understand what really drives equity markets, it's all about consumption. Now we've got the NASDAQ overlaid against real retail sales. That's shown in blue on a year-over-year rate of change. And what we can see going back to the late 1990s is real retail sales peak and starts to slow down. Stock prices continue to rally before they peak and follow real retail sales lower. As we move forward to 2007, they get more in line with each other as we see a slowdown in real retail sales puts a damper on equity prices. Next thing you know, they're both crumbling down. And how about as we move into 2021, we see real retail sales fall off a cliff. Stock prices start to come down. Real retail sales then go flat, but investors say, no, this is transitory. 3 years of flat sales means nothing. Consumers are going to spend and spend big, or at least that's the hope, as they're front running where the economy is going. And now we start to see what Jamie Dimon is warning about, that perhaps the equity market is priced for perfection. But if you're looking for something that's on a rebound, check out the stock for our sponsor for today's show, La Rosa Holdings. You can find them on the NASDAQ symbol LRHC. And let's take a look at the RS RSI and the MACD, you can see them rallying here. And we look at this 30-day chart, what do you see very clearly? Support coming in right at the volume profile line. You see prices rising with momentum. This is setting up what we believe is an 84% potential return. Stay tuned to the end of the show or check out the pinned comment or description for more information. But let's continue on with the theme that inflation is going to be a problem, because what it's telling us is there's a demand issue with the U.S. economy. That's what Jamie Dimon's warning about. He says investors have gotten ahead of themselves, and why pro-growth policies are something everybody wants, it doesn't mean the market could be immune from a massive correction. And let's take a look at what's again driving retail sales, and that is incomes. As we look at average hourly earnings multiplied by average weekly hours of production and non-supervisory employees, that's shown in blue on a year-over-year rate of change against the NASDAQ 100 in red. And what do we see? Where income growth peak. Now keep in mind, when incomes are rising, people tend to invest more, but more importantly, they spend more. And as income starts to decelerate, you get a peak in the equity market as we plunge into the dot-com bubble. Let's move forward to the global financial crisis. Where do we see? In around 2006, incomes start to peak. They roll over and decelerate. Equity markets continue to run higher only because income growth is still relatively strong historically. But as it continues to slow, consumer spending drops and equity prices go with it. We move forward to right around 2011. What do we see? A slowdown in incomes. Equity markets start to go flat. We see that happen again around 2014 into 2016. But look what the difference is now compared to the past. We see a continued slowdown in income growth, and yet investors are saying that U.S. consumer balance sheets, they're healthy. They can spend. They can afford these higher prices. And yet we continue to hear from consumers that they can't afford higher prices. And when you start to listen to the CEO of the largest bank in the United States, and if he's telling you there's risks out there, well, it means they are. Now let's take a look at the biggest risk, and we're going to find more information on this tomorrow. We see continued claims has a massive impact on equity prices. Not only are people not contributing to stocks and spending when they're out of work, but they're also pulling money out to pay their bills. Here we can see around 2000, you get a bottom in continued claims. It matches perfectly with the peak in the NASDAQ 100. As claims go higher, stocks go tumbling. We see that again right around 2007. We start to get a bottom in claims. They move higher, equity prices peak, and next thing you know, they're plunging. This time, we notice the same thing happens. The equity market peaks right as claims bottom. Claims continue higher, but for the first time in history, what we're seeing is equity prices front running what is likely to be, or at least the expectation, that there's going to be a massive resurgence in growth and inflation here in the U.S. But if we continue to see income growth slowing, if we continue to see people hit the unemployment line, this equity rally has some major risk of a massive correction, potentially when they could spin into an all-out bear market. And Dimon reiterated that he remains cautious about global deficit spending, the potential for persistent inflation and geopolitical issue. On deficits, he added that growth is the only real solution to reduce them, suggesting that perhaps the attempt by President Trump to cut spending will not work. But the real issue that he's referring to here is that government spending crowds out the private economy. So the bigger the deficits are, the less growth you're going to see from the economy, and the market's pricing in massive amounts of growth. What he's saying is we need growth to cover the deficits. Trump's saying we need to cut spending and drive growth. But I'd love to know what you think. What's the solution here? Does the government just need to drive the economy into massive growth mode to deal with the deficits? Do we need to cut spending, or do we need to do both? Weigh in the comments below. I'd love to hear from you. Because as I want you to see that while the U.S. stock market is rallying, well, around the world, not so much. And China's got this backwards, even though they're trying to follow in Trump's footsteps, as China eases rules for long-term funds to boost stock market. Again, we talk about how China's got this backwards. And there's a reason I wanted you to see those charts, because what do you see in the U.S.? It's about jobs. It's about incomes. And that's what drives equity markets. When people work, they spend, and that drives earnings, profits, and stocks higher. In China, you have the opposite setup. Their economy's heading to a recession, and the government is strangely fixated on the equity market. The central government issued a directive to steady the stock market and clear bottlenecks for the introduction of mid-long-term capital. And I want you to see just clearly how China has this completely backwards. While they're focused on the equity markets, they should be focused on what it takes to get their people to spend money. And there's a reason I wanted you to see these U.S. charts, because the equity market's all about consumption, and that's all about jobs and incomes, something that as China's economy heads into recession, they just don't have. But instead of focusing on what they need to do to get people spending and to put them to work, China's focus is on the equity markets, and that's going to be a complete waste of time, because Trump is looking to add more tariffs as a now 10% tariff on China threat cites trade deficit with the European Union as well, and this would hammer China's economy and already put a struggling European Union economy straight into a depression. And we're talking about a tariff of 10% on China based on the fact that they're sending fentanyl to Mexico and Canada. Other countries are also big abusers too, but you know it's not just China. Trump said we have a $350 billion deficit with the European Union. They treat us very, very badly, so they're going to be in for tariffs, and this is going to be a huge problem for consumers. We talk about the fact that the U.S. economy has not been impacted much by tariffs at this point or geopolitical issues, particularly the equity market. But if you come in and put tariffs on place, well, that means prices here in the U.S. are going to go up at a time when income growth is decelerating. That means we already know U.S. consumers cannot afford current prices. If they go up, they're going to be able to afford even less. It's a surefire sign that not just the rest of the world's going to head into a recession, but the U.S. consumer is going to drive ours into one as well. And Chinese stocks fell on Wednesday after Trump's latest comments, with the onshore benchmark CSI 300 index heads for its first decline in 5 days. And the Hang Seng China Enterprises Index, the worst performer in Asia, which just goes to show that even though you want the market to go up, even though they're trying to get more companies to buy their stock back and issue dividends, so those, of course, investors will turn around and buy more stock. It's about your economy, and everybody knows if these tariffs come into place, even in a small amount, it's going to hammer China's economy in a big way. But let's talk about inflation here in the U.S. as Procter & Gamble stopped hiking prices, and sales still grew last quarter, which perhaps is a great amount of relief for U.S. consumers. The problem, as you're about to see, is going to have a devastating effect on those who are working. The results suggest that the era of endless price hikes may be waning. Companies that make consumer and packaged goods have for years counted on price increases to help fuel revenue growth. In P&G's fiscal year that ended last June, prices were 4% higher compared to the year earlier when they jumped 9%. And here's the issue we're facing right now is that as inflation goes down, it's because demand is going down. And when demand goes down, wage growth falls. Now, you may remember last week there was a labor market statistic that said the year-on-year rate of growth for wages had dropped to 1%. For American workers, that is a danger sign of what is to come, because when we look at the consumer price index against average hourly earnings for production non-supervisory employees, that's shown in red, both on a year-over-year rate change. You can see that when demand goes down and inflation comes down, what happens is wage growth starts to peak and roll over. By the time we get into the early 2000s, the two get far more in sync with each other. Demand means less pay growth for those who do have a job. We see it happen again going to the global financial crisis, where rising inflation didn't lead to a lot of pay growth. It put people on the unemployment line. Those who did have a job still saw some gains, but there weren't enough workers to power the economy to stave off a deflationary spiral. We move forward around 2014. Inflation comes down, wage growth slows, and here we see it again. So the slowdown in inflation that Procter & Gamble is signaling is not necessarily a good sign for workers. What's validating is income growth is going to likely continue to slow at a time that prices are still too high. And the threat of tariffs says they may be even higher. And companies are under pressure to slow inflation as President Donald Trump takes office. In an executive order issued January 20, Trump said consumers are facing a, quote, cost of living crisis, and is, quote, critical to restore purchasing power to the American family. The problem he doesn't see here, and again, we're going to find out more information tomorrow and on every Thursday after this, is going to be the most critical economic data that comes out, and that is continued unemployment claims, because the reason we're seeing inflation come down is because demand is coming down. As we now take a look at the consumer price index, still shown in blue, against continued unemployment claims in red. And what do we see? That when continued claims start to rise, you get a peak in inflation, they roll over and head down. Now, when we move forward to the global financial crisis, we didn't see that because energy prices surged, but those energy prices that took off eventually came crumbling down into a deflationary spiral as demand got eviscerated as Americans hit the unemployment line and stayed there. Now we're seeing the same thing. The reason inflation's coming down isn't because there's just too much supply, and while supply is growing, one thing that is also growing is the supply of available workers because there aren't enough jobs for them. But one company that is raising prices is Netflix, as their share soared to a record after a huge gain in subscribers, which makes me wonder how long they will be able to keep this up. Because when I saw that, well, I canceled my subscription. I imagine many other people will too, as the company added 18.9 million customers in the fourth quarter. That was more than double what Wall Street expected and brought global subscribers at Netflix to more than 300 million. The company's previous best was 15 million in the first quarter of 2020, numbers driven by the onset of the coronavirus pandemic. So I'm wondering if the surge in subscribers had something to do with the fact that people were looking to alternatives because they weren't spending out in the real economy because they couldn't afford it. Now the question is, can they afford Netflix price hike, or will they look elsewhere for their streaming content? But something we believe is positioned to surge higher, that's a stock for our sponsor for today's show, La Rosa Holdings. You can find them on the NASDAQ under symbol LRHC. And let's take a look because they're making some waves in the real estate industry as they're empowering agents and elevating success. Everything you need to know in the pinned comment and description below. As La Rosa Holdings is a holding company that operates 6 agent-centric, technology-integrated real estate segments, including La Rosa Realty, franchising, property management, CRE, coaching, and a title agency. The company aims to disrupt the real estate industry by offering agents a revenue share model or an annual fee-based model with 100% commissions, supported by proprietary software and commitment to agent support and education. La Rosa Holdings employs a growth strategy focused on acquisitions, agent recruitment, and the expansion of ancillary services. The company aims for a revenue run rate of $100 million by the end of 2024 and expects to achieve profitability by 2025. La Rosa Holdings reported a 155% year-over-year increase in revenue to $51.7 million for the first 9 months of 2024, surpassing initial revenue guidance by approximately $6.7 million, which is one of the reasons why we think this could be a huge catalyst to send their stock price surging. Let's take a further look at what's going on, because residential real estate service revenue, property management revenue, and real estate brokerage services revenue all increased, and that is phenomenal. And La Rosa acquired real estate brokerage franchise was approximately $2.7 million in revenue for trailing 12 months and positive net income as of November 30th, 2024. CEO Joe La Rosa stated that the acquisition of Realty Beaches is anticipated to drive revenue growth and enhance margins through improved efficiencies and economies of scale, while presenting significant growth opportunities with his team of over 90 agents. And let's take a look at the opportunity here, because we think that La Rosa stock could surge as much as 84%. Let's check out these charts, because you're seeing a lot of buying support underneath it. Again, you can find them on the NASDAQ, the symbol LRHC. Let's take a look at this first chart, because you can see that even though their stock was in a prior downtrend, when some major news hit, it sent their stock surging. This time, what are we seeing? We see a very clear bottom here with upside potential right here around 90 cents a share. You can see where previous sellers jumped in around that prior peak. That's our upside target. Let's take a look at the 30-day chart, and what do you see? Very clear support here as buyers stepped in and put a floor underneath the stock. That's that horizontal red line. What that is setting up a move upside as buyers are looking to take the stock higher. We zoom into the 10-day chart. What do we see? Rising momentum with the RSI and the MACD. We see very clearly the support being put in underneath the stock by buyers. And again, we see it break through the volume support line. It pulled back to find support here. This is again setting up a potential 84% move in La Rosa stock. Again, you can find them on the NASDAQ under symbol LHRC. But as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.